Good morning to everyone. We are live.
Good morning to everyone. We are live.
We are live. Yes, and we are live
Yes,
today on
and
Money
we are
FM's
live
Behind the
today.
Markets. And thank you very much to everybody who's joining us on Wealth Wednesday. Please give us a tag. What's your name? Where are you joining us from? And what do you expect from today's show? Today we'll be talking about risk. Remember, we started on a series on investment risk, and we're going to take that all the way through the end, where I'm going to talk to you about how to actually calculate, mitigate, manage, understand risk when you're going into investing, because it seems a lot of people don't seem to be able to navigate it. But this morning, I want to say a good morning to my wonderful co-host and my co-pilot, Stephanie. How are you doing?
And my co-pilot, Stephanie, how are you doing?
Fine.
Sorry,
How are you, Munyumba?
fine. Sorry, Stephanie. I think in the studio, to those in the studio, I think we got a little bit of an echo
Sorry, Stephanie, I think in
on
the
there,
studio, to those
and
in
we're
the studio, I
getting
think we got a little bit of an echo on there,
yes.
and we're getting a
All right.
Okay. Is it
Thank
okay
you.
now?
No, it's not.
Thank
We're
you.
going to just keep you on mute for a second.
No, it's
Now,
not.
let's get down to the morning show. Let's get into this morning's conversation, where we're going to be talking about all matters Wealth Wednesday. But let's kick off as we get started with the matters of today. Let's get into the market roundup. The first thing we actually do see is that the Kwacha is strong. The Kwacha has lost 0.41% as of yesterday. The dollar is down 1.91% for the week, but up 6.28% on the month and 14.53% year to date. It's still in buying pattern, but with a little bit of MACD resistance that's starting to form around the old 21 point. Yesterday, we did see that the all-share index on the stock market lost its value. There is a bit of buy and sell, sideways trading happening on the Copperbelt Energy Corporation stock. So you do see that it's kind of sidewinding on the same price. The all-share index, however, is up 5.32% on the last 30 days and up 24.85% year to date, while the bond index is up 0.16% as close of yesterday, and the US dollar index is up 0.62%, while interest rates have come down about 0.86%. Now, if you're looking into the FX rate, also, we did see the Rand move up by 0.82%, putting a little bit of inflationary pressure on imported goods, South African imported goods. Remember that South Africa makes up about 30 to 35% of the products of the import market that we have in Zambia, close to about $2 billion worth of imports annually. And we are seeing an acceleration rate in the Rand itself, while we're seeing a slight deceleration in the dollar. So there does seem to be a little bit of a cap happening on the dollar, while the Rand may be picking up some steam. Other thing that we're seeing right now is that GRZ bond index has continued to move 0.16%, up 19.64% year to date, while year to date you're seeing the dollar version of it is up 4.72%, while interest rates are up 0.96% year to date. You can see that interest rates have still moved up, though they're starting to slide down just a little bit in the short run. Commodity prices are down. Copper is down 0.56%. This is due to excess stock in the global warehouses. While we're seeing oil prices did just kind of hold at 94, it does seem tight supply is still keeping oil prices at near session highs. We are seeing it that for this year, oil is up at almost a 10-month high, 94.04. Gold is down 0.13% also as of yesterday. Now, in terms of our pump price recommendation or our pump price expectation, we are still expecting that the pump price is going to be around 32.83, up 3.41 kwacha or 11.58%. We're seeing another round of hikes, so you should be seeing petrol prices up basically about 30%. Just over 30% over the last 2 months. That's quite a bit of transport inflation pressure that's going to build into the food supply chain and also into the general business supply chain as well, possibly also pushing up wage expectations and price expectations or earnings expectations by employees. That's something that we're going to have to pay very close attention to. Simultaneously, we're also looking at wealth insurance assets, which are currently, while Bitcoin is up 2%, you also see Ethereum up 0.8% and gold up 0.28%. This is mainly due to the output of the dollar. The dollar getting stronger, while Bitcoin has actually pushed up a little bit in dollars itself. Now, in terms of the broad asset mix, We have seen that as of yesterday, we did see that bonds are up 19.6% year to date, stocks up 24.9%, still the leading asset. US dollars up 14.5%, gold up 22.5%. It's the second stretch asset. So we're kind of seeing the same flow as we usually see in an average year. Remember that we always say stocks are your highest performing asset, but very volatile. Bonds are your most reliable asset. While we're also seeing Bitcoin up 87.7%, Ethereum up 56.3%. Year to date. When you look at the quarter, Ethereum is up 0.9%, Bitcoin up 4.9%, gold up 19.3%, US dollars up 17.8%, stocks up 11.2%, and bonds up 5.6%, the stable baseline that we're actually starting to look at. Now, in terms of our four horsemen outlook, first thing we're seeing right now is that in the US, we saw API crude stocks down by 5.2 million barrels. This is what's also keeping oil prices relatively high and quite a bit of pressure still on the oil price. Simultaneously, we are seeing core inflation rising up in Canada, and general inflation also rising up in Canada, while European inflation slightly went down. Those are mixed reads. Chinese interest rates stayed the same in terms of their 5-year prime and loan rate, while we saw US dollar 20-year auction rates going up and 30-year gilt rates in the UK going up. So interest rates are still elevated with elevated inflation around the world. Unfortunately, incomes are coming down while Japanese exports are starting to slow down. Exports are still contracting. Red book sales, in other words, retail sales in the US, are also coming down by 3.6%. So have slowed down to 3.6% of year-on-year growth. Housing starts as well are also up, have also slowed down in the USA, while building permits have picked up. So you're getting weak industrial data with a few little spots of potential growth, weak income in terms of slowdowns of income, elevated interest rates, and elevated inflation, which should be coming down, but is still relatively elevated. And that's what we're looking at in terms of how the markets are doing altogether. I think we finally got Stephanie back now we're switching into our daily. We're switching into our daily deep dives. We just got a few stories in which are mostly international stories. Copper prices do continue to slide amid high interest rates and rising inventories. So remember, copper prices affect how much dollars the government has. Copper prices also affect how much dollars the country flows in, and also it affects the strength of our currency. So when you have high oil prices and low copper prices or weak copper prices, you start to get a weak kwacha. Because remember that the country is basically dependent on exporting copper and importing oil. These are the two biggest things that we're also seeing. But unfortunately, also debt plays into it, though we've started to slow down how much debt finance is starting to leave the country. So right now, it's really a function of low copper prices, high oil prices. Now, while the Fed's not expected to increase this week, there are prospects of maintaining high interest rates to combat inflation. So higher for longer is seeming to be the statement that's coming out of a lot of analysts' mouth. The expectation is that interest rates are going to stay higher for longer. Therefore, until we start to see EV demand and higher smelter capacity growing, picking up, we're not going to be seeing higher copper prices until probably about 2025, going into 2026. Sluggish economic growth also from China, and investors also worried about the country's debt-laden property sector. Remember that a lot of copper currently ends up in Chinese property and infrastructure. So when you've got low Chinese property and infrastructure activity, copper output also starts to suffer as well. Traders are also monitoring the depreciation of the Chinese yuan. So the Chinese currency is also making copper more expensive for them. So they're also starting to slow down in their purchasing of copper, and it's affecting the demand of dollar-based industrial metals. And finally, we're also seeing that LME stocks have also surged 175% since mid-July to 149,600 metric tons, reaching the highest level since May 2022. This rise has also been coming mainly due to low demand and an inventory buildup in copper. So this is what's pushing copper prices, which is actually affecting our currency and also affecting some of the mining economic activity in the country. Now, one of the biggest stories that's also hit as well is global debt has hit a record of $307 trillion. And debt to GDP ratios around the world have risen. And I know a lot of Zambians will be shocked to hear this, that other people have got worse than us. Global debt is 307, not billion, Stephanie, trillion dollars. In the second quarter of the year, despite the rise in interest rates and the curb in bank credit, it does show that that markets such as the US and China are driving this rise. In other words, global debt in dollar terms has risen by $10 trillion in the first half of the year, and over the last decade, Over the last decade, we've actually seen global debt rise by 100 trillion, not billion, people, trillion. Let me just give you an example of what we mean by trillion. The African GDP, Stephanie, is 3 trillion. Okay, Africa's whole economy, from top to bottom, from Cape to Cairo, from Abuja to Ethiopia, that is from Abuja to from Abuja to Addis Ababa. That is about that's $3 trillion. So this is 100 years of African GDP that the whole world has in debt. Now, simultaneously, the global debt to GDP ratio as of the second quarter is 336%. So in other words, we obviously get tanned as Zambia for having a debt to GDP ratio above 80%. The world has a debt to GDP ratio of 336%, mainly due to Japan, America. These are countries that are heavily in debt. Japan actually has about over a 200% debt to GDP ratio, and that is mainly, yes.
Are we picking calls now?
We'll be doing that towards the question session, which will just be in a few minutes. So if you have any questions, just call in the next 5 minutes or so.
You might want to give us a call later on 077-1616-290 in the next 2 or 5 minutes.
Yeah. So now what we're also seeing is global debt to GDP ratios for the second straight quarter are now up to 336%, meaning there's three times more debt in the world than there is economic activity. That's like Stephanie saying that your income to debt ratio, your annual salary, let's say your annual earnings are only 1/3 of the debt you owe. That is unsustainable, the amount of debt that has been issued in the world, but unfortunately, a lot of it has been issued in the developed world. More than 80% of the latest buildup of debt has come from developed countries, which are US, Japan, Britain, and France, which have registered the largest increase. And for the first time, we've seen emerging markets are not the key driver of debt. So this has been a big conversation about how the global debt market and how eventually we're going to unravel this, because I think we've gotten used to this idea that governments can perpetually just print money and artificially create debt without it ever having to be repaid back. And this experiment, unfortunately, looks like it's going to backfire somewhere in the future, probably leading to, and this is why Ray Dalio has been predicting a change of the world order. He's saying that the moment you start to see leading economies going into huge amounts of debt like this, you often see a change in the world order. That's usually the biggest stressor in the global economy. Now, let's get into today's topic of discussion. Obviously, we can open up for people who would like to call. The question we always want to ask today, Stephanie, is what is your strategy for managing risk? When you see a risky situation, like any risk forming in any of the businesses or anything you'd like to invest in, what is your strategy for managing risk? That is a question that we are throwing out to our audience. Stephanie, I don't know, whenever you are trying to gauge risk, what is your personal strategy? And how risk averse are you? How risk averse are you, or how tolerant are you of risk? And what's your strategy for managing risk?
My strategy for managing risk is, I think I prepare. I think about it before getting to actually take on that risk. So for me, I think risk, I just gauge it as it is. Yeah.
And maybe the question is, what is your definition? Personally, what is your personal definition? What is it that makes something risky to you? What's your personal definition of risk? I'll throw it back at you, Stephanie.
Something that scares me, of course. Something that I stand losing if I lost would actually hurt or injure little. For me, that's a risk. Whether it was a business, whether it was emotion based, whether it's in terms of work, but that's risk for me. Something that's worth losing. So I take my chances. I take my time. But of course, I love risky stuff.
No, as I said, I'm a calculated risk taker. I am a risk taker, but I'm a calculated risk taker. So I would like to throw this question at all the people who are watching right now. What is your personal definition of risk? That's question one. And question two, what is your strategy for managing it? So we'd like to find out from our audience, when you're entering into any investment or business venture, what is your definition of what is considered risk? And also, what's your strategy to manage it? Because remember, you don't run away from risk, you manage it. Because if you run away from risk, that means you're always running away from opportunity. That's something you always have to remember, because within every opportunity lies there a risk. So we are starting, remember, a series on risk, investment risk. And this is what I have been pushing out here, understanding risk. It has been something that I wanted to get to as many people as possible. And it started with Warren Buffett's statement: rule number one, never lose money. Rule number two, never forget rule number one. So basically, he's telling you, do not squander money, people, or don't lose it at all. So that is our definition. That is his definition of risk. Now, I always want to say the three enemies of wealth are consumption, spending all your money and not investing. This comes from poor savings rate and slow income growth. Two, conservatism, being too conservative and keeping your wealth in assets that grow too slow, cash or cash-like assets, or being highly defensive or scared. And three, taking unnecessary, unbalanced, and uncalculated risks. So losing money, so carelessness, short time horizons, speculative, big gambles, or non-cash generating assets. You're betting on the price of something going up and being able to sell it for more in the future, and you're not taking into consideration the market that's going to be there in the future. So that is one of the things you're trying. That's what we call uncalculated, unbalanced, and unnecessary risk. So consumption, conservatism, and carelessness form the basis of the biggest enemies to any wealth activity. So we always say, and we do have some definitions here. And we started talk last time about what is risk. These are some of the questions we asked. We talked about risk-free assets. We said risk-free assets. There's certainly no security that has no risk at all, but there's some where the risk is so small they are considered risk-free. So riskless securities often form the baseline for analyzing risk, and these are fixed deposits and savings accounts. They can fail. If a bank fails, you can lose your deposit. It's just highly unlikely. GRZ securities, treasury bills and bonds, investors can lose their money if the government defaults on debt, but that's also highly unlikely. It's not impossible, but it's highly unlikely. And the 364-day treasury bill is considered the baseline for risk. Now, I wanted to go into this conversation, Stephanie. Last time we talked about your personality type. Well, how much risk are you willing to tolerate as a person? And we said each person has a unique profile of risk. And it's the risk tolerance factors are personality, lifestyle, life stage, time horizon, age, the need for liquidity, your experience with markets, and also the market environment. If it's a very high risk, turbulent environment, you tend to hold off on taking too many risks, whether in business, whether with money. So one of the things that also affects your personality, the type of risk taker you are, can be obtained by understanding what we call your Jungian archetype, your Myers-Briggs personality type, and your Ramsey solution, know your money, know yourself, money personality test. So always remember that these are your options when it comes to taking risks. So in general, you want to know that in general, as investment risks rise, investors expect a higher return for those things. But how much risk are you willing to chase and tolerate? So here's what I was actually pointing out in terms of your personality. So I'm going to give you, there's 4 components of the kinds of people who are and their risk behaviors. There's people who are very conservative, moderately aggressive, and very aggressive. Or what we call protectors, planners, pleasers, and players. Okay? These are your 4 areas of what we get. Now, if you look at your Myers-Briggs personality, if you've ever done your Myers-Briggs personality test, I think you can do that from a site called 16 Personalities, for example. You assess which one of these you are, and it tells you already. These have been categorized by risk appetite in terms of these ones. Then even your Jungian archetype, there are 12 Jungian archetypes, and you can actually find that out through I think there's a lady named Kate Putnam who does a test online, which are able to derive all of this. Are you an innocent, regular, sage, ruler, caregiver, lover, jester, outlaw, hero, magician, creator, explorer. I am an outlaw. That's my one there. My one is an outlaw. I am more of a pleaser. I'm moderately aggressive. I'm an ENFP. I'm an outlaw, and I'm moderately on the side of a spender, while I'm moderately on the side of security, while I'm moderately on the side of abundance. So if you know your Ramsey personality, know your money, know your test, it tells you, are you a saver or a spender? Savers are very conservative. Spenders are aggressive. Security conscious, if you think of money for security conscious people are conservative. Status people are aggressive. Scarcity people who think of money as scarce, they think it's they are very conservative. People who think of money as abundant, they are aggressive by nature. So always tap into who you are, because people always think, no, if you're a spender, that's a bad thing. It's a bad thing if you're a careless spender. But if you know that you're a spender of money, then you have to be very aggressive about how you make that money. And you have to be aggressive about how you invest that money. So you always have to couple your consumption style with your investment and earning style. Okay, that's what really helps. It's not about, Stephanie, whether you should stop being a spender and start being a saver. It's that if you're a spender, you must be an aggressive investor. Okay, and you must be an aggressive earner of money. That's when you find that you can be a sustainable spender. Dave Ramsey himself, who everyone thinks is a saver, is actually a spender. And he actually just says, because it's that makes me aggressive by nature. So this is a psychological evaluation they've actually done at Ramsey Solutions to be able to do this. So if you can take these 3 tests, look for your Myers-Briggs personality, your Jungian archetype, and the Ramsey Solution money personalities test, you'll be able to categorize what yourself is. So this is a scientific approach that we try to take, because everybody can think maybe they are who they are when it comes to risk, but it's also a good idea to use psychological evaluations, which is what most professionals in my field try to do. Expose people to psychological evaluations to try and help them come up with the best metric of what kind of risk taker they are. And you'll be able to find that you're somewhere. I'm a moderately aggressive risk taker. That's what I am in general. I'm a moderately aggressive risk taker with a little bit of a proclivity to higher risk as well. That's through a lot of risk. That's through a lot of assessment. I was able to understand that. Now, some people are very resistant because they don't like being boxed in. You know, I always say there's a freedom, Stephanie, in finally understanding who you are as a person. So today I wanted to talk mainly about types of risk. I opened up recently about the conversation of types of risk. And there are many types of risk I want us to go to. But the broad category of risk, first, is what we call systematic risks. These are risks that affect the economy at large. Okay? So these are not specific risks to an investment or a venture. These are environmental risks of the economic environment. So the market is at risk of losing investments due to things such as maybe the policies have changed, macroeconomic changes that are making it volatile, things like inflation, the FX rate, liquidity, the country risk, the interest rate that's apportioned to the country itself, socio-political unrest. We've just had strikes and we just had protests at UNZA. That's unrest that can sometimes reflect into, it's just that doesn't go nationwide. But if that did go nationwide, that is social-political risk. They, for example, in Nigeria, they're starting to see a lot of labor strikes happening in Nigeria. That's broad social-political risk starting to take place, and it's baked into the interest rates that are actually going into Nigeria. The second thing we're also seeing is unsystematic risk, specific or idiosyncratic risks. These are risks specific to an investment. Okay, for example, we've talked about things like Copbelt Energy, who has a specific risk because they're doing business with the government, and therefore they carry a lot more political risk. Their biggest supplier is the government of electricity. When it comes to electricity, some companies are exposed to environmental risk at higher levels. Companies like Zaficos, companies like Zambeef, they're exposed bigger to environmental risk because that affects crop yields, it affects animal production, and they've got a higher exposure to it. Certain people are exposed bigger to interest rate risk or bank failures because they're in the banking sector. And then also there's inherent risks inside the company itself. maybe it's not operating properly, maybe it's got very high costs. So these are due to companies or industries themselves. So changes in management, product recall, regulatory changes, a new competitor. Okay, we've talked about how on the internet space, Elon Musk's Starlink company coming in poses a threat to companies like Airtel that may be now rising, that may be driving a lot of their growth through their internet services. So you can see how to measure what is a systematic risk to the broader economy and what's a specific risk to an investment itself. Because yes, you do operate in a broader economy, but you do also operate a specific economic activity, or you invest in an economic activity. So we're going to go through now some specific types of risks, Stephanie. So whenever somebody is looking for what are the risks of making an investment or going into a business, here are the actual technical categories of risk that an individual should be looking for whenever you're looking out for risk. Now remember, you're not looking at risk as a reason to run away. You're looking at risk as a method of managing it. Okay? I don't know if there's a call or something there.
I'm trying to, there was there was a call, but of course, this one is cut. So, yeah.
So let's go into the types of risks that we're looking at. And these are, and as I said, Stephanie, I don't know if some of these are things you may have already come across or may have not, but these are some of the types of risks that you need to assess in any economic venture. Even your job, people. Always look at risks, even your job. You know, the biggest problems with employees is that they get so comfortable, they think that job is going to last forever, that one day they just get the shock of their life that the workplace has either shut down or they're getting retrenched. And then their life gets thrown upside down because they were convinced that this income they're earning was something that was guaranteed. There are no guarantees in life. I want to just quickly always say to people, even Jesus Christ said it himself. In this world, people, there will be troubles, okay? Ups and downs, hot. God actually baked it into this world. He said there will be hot, cold, there will be summer, winter, okay? It means that there is variations and there are seasonalities. Those things are baked into the functionality of the world, that there will be variations and there will be seasons. So some days will be hot, some days will be cold. So there will be a summer season where it's generally hotter. There will be a winter season where it's generally colder. So you have to always look out for cycles and seasons and variations. And that there, Stephanie, lies in all the risks. So if Jesus Christ can tell you there will be troubles and God is telling you there will be variations, then risk is part of everything. Okay? So you can't run away from risk. You have to manage it correctly, expect it and manage it. So the first type of risk, Stephanie, is business risk. Whether a company is able to make sufficient sales to generate revenue to cover its operational expenses and turn a profit. So in other words, you're looking at the cost of goods. So a company can mitigate this by managing its cost of goods, by managing its profit margins, by being competitive, building an economic moat around itself. That's why Warren Buffett always looks for companies with an economic moat, a defense, a way that they can protect themselves from competition and overall rising demand in the economy. So this is what, or in the actual sector of the economy, like there's overall rising demand for internet services in Zambia. There's overall rising demand for mobile money transactions in Zambia. So that overall rising demand will protect a lot of people from business risk. Operational risk, Stephanie, now is associated with system failures, human error, fraud, and other internal processes. So when things go wrong in the internal operations, so businesses need to have good internal controls, processes, and systems to be able to overcome that. So you're asking, how are they mitigating against operational risk? Legal risk is when there's changes in laws, there's changes in regulations, there's legal disputes that have now settled, whether a company is being sued, taken to court, are they in court for something? KCM and CEC, that's been an arbitration, that's a legal risk that finally got mitigated, but that was there. So it's mitigated by compliance programs, monitoring regulatory changes, and seeking strong legal advice. So do they have a strong legal team? Are they monitoring regulations? And are they doing compliance? By the way, if you're an entrepreneur, these are things you also want to pay attention to, especially. Other types of risks, Stephanie, whenever you're looking at investing, are credit and default risks. So this is the risk that the person who you've lent money to or who has issued you a bond, an instrument which basically says they're going to pay you back or pay you a periodic sum of money until they pay you back. is unable to pay according to their contractual obligations, either the interest they promised you, even the principal as well. So you want to use this by also using credit ratings and credit screenings. Who are the people who are the most likely? No one is definitely going to pay you back. It's just you're looking for people who are most likely to pay you back. And you also diversify between different groups of people in terms of that. The other thing you're looking at, Stephanie, is country risk. Country risk also is the risk that a country, so Zambia as a whole, remember when people bought our Eurobonds, will not be able to honor its financial commitments. And you're using credit ratings as well and geographic diversification to be able to do that. So country risk is established when a nation, not just an individual, is not able to pay its bonds and its financial obligations. There's foreign exchange risk. Okay, financial instruments that are in a currency other than your domestic currency face a currency risk, because if you're holding dollar assets, if the value of a dollar goes down, the value of your asset goes down. So unfortunately, right now, we don't have access to a Forex futures and forwards markets. And if you try and go directly to your bank, you'll probably find that Forex futures and forwards are quite expensive. We used to be derivative currency traders, and this market is quite illiquid because you don't have a lot of banking participation to help businesses hedge their future FX risk. So let's say, Stephanie, you're a business that imports inputs, okay? Maybe let's say you get juice inputs from Cape Town. You have a Forex risk in the cost of your juice inputs. You do see that companies like, for example, National Breweries have stated that they carry a Forex risk because the packing materials for Chibuku are imported. They're not domestically created. So therefore, they have a Forex risk. So how do they hedge against it? So sometimes the asset or even the asset's operations have got a Forex exposure to them. So that's what you're trying to manage against. Now, I often get asked this question, Stephanie, because Zambians will come to me and say, but what if the Zambian kwacha loses value against the dollar? How do I manage against that? I don't want to lose my investment in dollars. And I keep telling people, measure your asset by your liability. There's something called asset liability matching. In other words, if you are going to spend your money in kwacha for retirement, then the majority of your retirement savings should be in kwacha, okay? If you are planning to retire in Zambia, then keep the majority of your assets in Zambian kwacha denomination. The reason is you don't want to carry an FX risk that might work against you in the future. And I've pointed out to people that the dollar has actually been one of the worst performing assets, especially over the last 22 years. So in the long run, the dollar is actually the worst performing asset, even worse than depositing your money in a Zambian kwacha cash account. Other risk, Stephanie, is interest risk. In other words, this is the risk that an investment will change its value due to the change in interest rates. So bonds, if you're trying to trade bonds on the secondary market, they lose value if the interest rate goes up. So the best mitigation would have been bond derivatives. But for example, with bonds, what I would say is short duration. Shorten the duration is a way to mitigate the risk of interest rate changes affecting the secondary value of your asset. That's if you're interested in trading the asset on the secondary market. If you're not, interest risk does not really stick with you. Reinvestment risk. In other words, this is the possibility that the investor may not be able to reinvest cash flows they receive from an investment, such as dividends or interest, at the same rate of return of the original investment. Now, this also happens when maybe you're getting bond coupons and you're seeing that when you reinvest in new bonds, you're maybe not getting the same rate of return that you were getting from the previous bond that you invested in. That is a reinvestment risk. Or maybe let's say a stock has issued dividends, but its price is going down. So you're losing the rate of return, or it's slowing down in how it's growing. You're losing the rate of return. So laddering your assets also helps, diversifying your portfolio and considering investments with different maturity dates. That is what we call the laddering process. It's something I've taught to many people. Now, as I said, there's a plethora. This is what we call the risk universe that I'm taking people through today. And I'll be going through a lot of the risk story. Is political risk. Whenever you're in business or investing, you have to consider political risk as well. This is the risk an investment's return could suffer because of political instability, changes in a country from a change of government, legislative bodies, or other foreign policy makers or military control. So things like Gabon is going through political risk right now. Political risk for me in Zambia is that I don't know what the voters' temperature is. Zambians shift between populism and professionalism a lot in the voter spectrum. This is why I tell anybody who's a bond investor, cap the duration of your bonds at 5%. Don't invest at higher. Don't invest in assets that lock you in longer than 5%. Don't do that, because you don't know how our people just switch their thinking very quickly. Our people, they change their minds very quickly. So you want to make sure that you're not overly exposed to a change of government. Like if you look very carefully, how the 2000 to 2011 government, they considered building reserves, conserving spending, strict budgets, low interest rates, economic stability. The 2011 to 2021 government, they were spending money, spending everything. There was FX loss, high interest rates, high inflation. So you have to understand that Zambia's economy is in the hands of its capacity to change governments very quickly. So you have to make sure that you cover your political risk also by shortening the duration or the lock-in periods of your investments. Counterparty risk, Stephanie, is the probability that the other person in a trade is not able to honor their agreement. Got to make sure that you trade on strong exchanges for that. Make sure you trade on strong exchanges for that. Liquidity risk is the investor's ability to transact to transfer their investment for cash, and usually you get a premium. If something is illiquid, like a house or something, you want a premium for it. So on things that are illiquid in general. And those are your sources of risk. These are the 5 categories of risk that you should be looking at. Please take notes, take them down. So whenever you're assessing an asset, an investment, a business opportunity, look for business risk, operational risk, legal risk, default risk, country risk, forex risk, interest risk, reinvestment risk, political risk, counterparty risk, and liquidity risk. These are your major risk categories. And there are other risks obviously there, but these are your major ones that you want to look out for. Next week, when we'll be talking about risk, Stephanie, we'll be talking about risk reward, how to measure it and how to manage it. And I'll also take you through what we call the Bridgewater approach of investment diversification to help you understand how and why you should be diversifying your asset portfolios gradually and over time.
Thank you very much, Munyumba, for today.
Thank you very much. We do have one, I think we just had one comment here from Wilfred Mlengo, who said, my definition of risk is something that can lead me away from my goals. I manage my risk by viewing the pros and cons of opportunities and the success rate of that opportunities. I always say to people, dream of possibilities, but plan with probabilities. Okay? Mm-hmm. If you always look at the probability, the percentage chance something can happen, that is what should guide each action. Your direction, your dreams will take you there, but make sure every step happens with probability. And I leave that there. Thank you very much, Stephanie.
Enjoy the rest of your day, Munyumba, those that are listening to us on the mainstream. To our Facebook family, it's bye for now. Till tomorrow again, same time, same place.